Thanks everyone for joining us tonight. I know we're getting started a little bit late, and I apologize it wasn't an easy place to get into. But tonight we're going to go through a couple things. We're just going to give a short introduction into multifamily, talk a little bit about how it works. I don't think, are any of you, I know Remy's invested in multifamily. Is anyone else, and Casey, of course you are. Is anyone else here invested in, and Larry? Anybody else? And you are as well, okay. All right, so this may look familiar to you, some of this. But we're going to go through the basics of how it works, basically how our investments generate cash, and then how we increase the value of the properties. And then we're going to go through an example of a property we just purchased last March and show concrete examples of how it worked for that particular property. So to start out, to give you just a little bit of information about ourselves, Nicole, Ron, and I, and Nicole's in the back, and Ron as well.
I'm Ron.
We formed NSpire Assets last year, but Nicole has been investing. She purchased her first complex in 2008, end of 2008. And I started investing in apartments back in 2010. But I actually invested with Nicole first, and later we decided to, well, I had such a great experience investing with her that later we looked at the opportunity to work together and bought our first complex together last spring. So as I mentioned, Nicole started NSpire Management back in 2008. And she actually won the National Apartment Association Independent Rental Owner of the Year in 2010. The National Apartment Association, of course, is a national organization, and each year they will recognize an owner who has, actually maybe you should mention a few things about the criteria they look at for.
Well, they have different categories, so this was for the property that we purchased in December, which is our first purchase. It was less than 100 units. And you do a submission, and there's people from all over the country that are submitting for what's called the Paragon Award. And the Apartment Association picks a property based on the things that they ask you for, which is like a rebranding, the property, financials, a lot of different criteria.
Community impact, things like that, right?
Yeah. Mm. And so our property was kind of an interesting case because we purchased it with cash. We didn't have any bank funding on it because of what was going on in the financial markets back in 2008. So it was kind of an interesting case because we ended up making that property. It was very, very distressed and stabilized in a very short period of time. We were able to put permanent financing on it and return a huge portion of our investors' money. So that was part of the reason why we won that award. The other reason being that we made a huge difference in this property to the community and also to the residents.
Yeah, actually I think I met you. So I got involved in multifamily through a club in the area called Lifestyles Unlimited. And it's a real estate club. I was looking for somewhere else to invest my money than the stock market back in 2008, 2009. And I actually read Rich Dad Poor Dad and got excited about investing in, like many people, and got excited about investing in real estate. And I was actually looking to invest in single family, and I found this club through James. Actually, James, you're probably the reason I'm standing here, believe it or not. So James introduced me to Lifestyles, although he wasn't a member. And so when I first joined Lifestyles, they talked about, of course, single family, but they said, hey, you can also invest in multifamily. And so I was really excited about multifamily. I jumped in, and Nicole was a bit of a legend there. I don't know if, let's say, Nicole's well known in Lifestyles. I think she's one of the more successful investors at Lifestyles at the time. And she had just won the award, and that's why I first tried to invest with Nicole. And actually, the very first property that I was going to invest in was next to a school, and right before the property closed, or was supposed to close, the school came back and offered to buy the property from the partnership, even though they had actually not purchased the property yet. And even though I hadn't invested any money with Nicole yet, I just expressed my interest to invest. Nicole actually shared the profit from that with all of the investors. So I think it was like 9% maybe return on that. Even though even though I hadn't given Nicole a dime. Yeah, so that's when I knew, all right, this is someone who I can trust and who I want to work with more in the future, and then I invested in Nicole's next deal. So here we are 4 years later, and now there are 4 properties. So Travis Gardens was Nicole's first, and then Villa Gardens, where I'm a passive investor. And then last March, we purchased Woods of Haltom, which the case study we'll discuss later this evening. And last Monday, we just closed on townhouse apartments down in Ennis. So that's us in a nutshell. So we'll talk a little bit about why we like multifamily, again, where the sources of income are from multifamily, how properties are valued, how you can generate value in properties, and we'll use Woods of Haltom later as the case study, where we'll walk through and talk about what the property looked like before we bought it, what we did to it, how the income has changed, and now what that translates to in returns to the investors. So I told you a little bit, back in 2008, 2009, we all remember what happened. We had a roller coaster with the stock market, and at that time, that's when I became interested in looking for other types of investments. I still invest in the stock market, but I recognize now that the stock market pricing does not necessarily reflect the value of the company so much as it reflects the sentiment of the market. I was looking for other places to put my money that weren't so sentiment driven. So now I take advantage of the sentiment. If I see stocks go down in value based on some bad news, it's a great opportunity to buy. But I don't want to have all of my investments sitting in the stock market. And so now I have, I would say, most of my money in real estate, but I do have some money still in the stock market. You know, the companies are making money, but again, it's very sentiment driven as to the value of the investment, and depending on your timing getting in and out, you may not make any money in the stock market. But what if we could invest in companies that weren't sentiment driven? And that's what really first got me interested into multifamily. So why multifamily? I think one of the biggest reasons is it's a company backed by an asset. So in this case, real estate. One of the most appealing aspects to me was the fact that these companies cash flow from operations. So it's not like you're buying a house and hoping it appreciates, or buying land and hoping it appreciates, or buying a piece of stock and hoping it appreciates. You're buying a cash flow generating asset which is generating cash, or if you're successful, is generating cash on a regular basis. And I put 10 to 15%. That's usually the range that we see our investments. I'm in about I think 7 partnerships now, and most of them are in that range. Some are a little bit less, some are a little bit more. But when we're looking at investments, we're usually targeting the cash return piece to be somewhere in the 10 to 15% range. And when I show you our portfolio at the end, you'll see exactly what we've been distributing. And I think from our 2012 results, we've been in an 11 to 14% range on these 3 properties that we have. The other big reason that we invest is the opportunity to do forced appreciation. So this is where we buy a troubled asset, much like a foreclosure on a home. We identify the issues with it, we fix those issues, and then we sell it later at a stabilized value and not at a depreciated or a distressed value. And that's probably the biggest knob that we have to generate income. Equity buildup, of course, you're paying down your loan over time. There's inflation protection, owning a real asset, especially one that people will always need to rent. So even when the economy is bad, they're going to be renting. When the economy is good, they're going to be renting. And one interesting thing about apartments in particular is, in the past, everyone wanted to own a house. It was the American dream. And what we see that changing now, where people want more flexibility. So people want the ability to move. Maybe maybe their job is going to move them to another location, or they're worried their job may move them to another location. So occupancy in the country right now is very, very high because people want that flexibility to move. Also, some people want some of the amenities that apartments offer. So they might get into a nice complex that has a pool and a coffee bar and community areas things that they may not be able to afford in a house. And of course, a lot of people are living in apartments right now because they can't get financing for houses. Will that get better? Some of that will get better over time. It's a mature model. This is nothing new. People have been doing apartments for a long time now. The market changes. Right now is a very hot time in the market. Sometimes it's slower. Right now, occupancies are very high and rents very high, so the market does change over time, but it's a well-understood business model, not something that we're trying to reinvent or invent. And last, it's a passive investment opportunity. So I know myself, when I first got involved in multifamily, I wasn't looking to be involved in any way. I just wanted to put my money in, let someone else manage it, receive my check at the end of the day. Now I actually want to be involved in managing it. But if you have no interest in doing that, it is a passive investment opportunity. So the sources of profit, and I'll show an example and also the case study at the end so you can see real numbers. But basically we make money from operations. So we're collecting rent each month, we're paying our expenses, we're paying off our loan, and what's left is the cash flow from operations. So when we're distributing cash on a yearly basis, it's coming from cash flow from operations. We're also building up equity. Of course, that we don't capture that until we sell the property. There's forced appreciation, so this is increasing the value of the property. These properties are valued by the income they generate. So as we increase the income on the property, the value of the property goes up. And I'll show you an example of that in a bit as well. We can get some of that value out before we sell by refinancing, which we've done with several of our properties. Nicole's Travis Garden property has refinanced twice now. So they've pulled out 120% of what they put into the property, but they still own the property. And we're now looking at refinancing Villa Gardens and potentially Woods of Haltom if we don't sell it this year. So it's a nice way for us to get some of the value that we've built up in the property out and still own the property in the end. And then repositioning, again, if we buy a property that's distressed, it's in poor physical condition, it has poor tenants in it, not only is it, well, in this case, it's really not valued off the income. It could be. It's possible that it's valued off the income. But usually when it's distressed, it's performing so poorly that it's not, the cap rates are just very high. And we'll talk about cap rates in a minute. But if you can go in and improve the quality of the asset, then you can improve the cap rates as well. And I'll talk a little bit more about that. So let me just show you a relatively simple example of the cash flow piece and the equity build-up piece. So let's say we purchased a 100-unit property for $1.8 million, so that would be $18,000 a door, which is the property we bought last spring was $18,000 a door. Let's say that we got a 75% loan on it, so we got a $1.35 million loan on the property. Then we put 25% down, so we would have $450K roughly of our own equity in the property. Now we'll actually have a little bit more than that because we'll need working capital and we'll need prepay insurance and a few other things, but just for this example, let's say we put only $450K in. Then let's say the loan's 5%, 30-year amortization. Our loan payment will be $87,000 a year on this $1.35 million loan. 26K of that's principal and 61K of that's interest. So now let's look at what the cash flow would look like. So let's say that the property has an income of $662K and the expenses are $500K, which leaves a net operating income of $162K. The numbers here are actually realistic, but I'm not going to explain how I got to those income numbers. So now if the net operating income is $162K, I pay my loan payment of $87K, and I pay for capital improvements. So as you own the property, things are going down, like your HVACs might go out, your appliances might go out, you're turning units and you're putting flooring in. So your capital expenditures are things like that. And the average is around 300 a unit a year. So if we have 88 units, 300 times 88 units each year. Sometimes some properties are a little bit higher, some are a little bit lower. But for the sake of this discussion, let's assume it's 300 a unit a year, which is 30K on 100 units. So the cash flow at the end of the day would be 45K. Does that make sense? Yeah? Okay. So your cash on cash return on your original investment of 450K is 10%. So I made 45K in cash flow, it's 10% on the 450K. But I also paid down my principal here of 26K. So my 26K of principal plus 45K of cash is 71K. So my total return was 15.8%. Does that make sense?
Can I ask a question?
Yes.
You said you're not the 450K, 25% down, you're not including other costs.
Yes.
So meaning your cash on cash return 10% is not correct.
Yeah, it would. Yeah, it would go down. This is one example. I'll show you some of the numbers that we're achieving I tried to make it a simple example.
10%.
But generally speaking, we won't do an investment if it's going to do a 10% cash-on-cash return. And you'll see that from the numbers later. This is just for an example. I'll improve my example for next time. So far, so good? All right, so so we talked about cash flow. We talked about equity buildup. That's these two components. Now let's get a little bit into the value increase. So first, let's talk about cap rate. So the simple way to think about cap rate is it's the price that someone's willing to pay for a certain amount of income to be generated. So for example, let's say a property has a 10% cap rate. If I pay $1 for that property, I'm expecting 10% on the dollar in income, or 10 cents in income. If it's a 5% cap rate, I'm expecting 5 cents in net operating income or unleveraged income off of that $1 in price. So you can see, so if you take the income divided by the price, that's the cap rate. So here's a basic question. If the cap rate stays the same and I'm able to increase the income for an asset, what happens to the price? Don't everyone shout out all at once. It increases. Okay, so this is the main mechanism behind value add opportunities or forced appreciation opportunities. And actually we can improve the cap rate as well. But let's assume the cap rate is the same. If we're able to increase the income, then investors are going to be willing to pay more for the asset. Okay, so cap rate. The cap rate is a function of the asset class and the property valuation is a function of the asset class, which the cap rate measures, and the net operating income. So the asset class is really a question of how old is the property, what's the condition of the property, what area is the property in, what's the submarket like. And you'll hear there's basically 4 types of classes: Class A, B, C, and D. Class A are your brand new properties. They're your uptown properties. They're in nice areas, good tenants, good quality. They're relatively new. Class B, a little bit older, a little bit cheaper to buy, maybe 35 to 50K a unit. Class C, much older, 60s to 70s, maybe 15 to 35K a unit. And then Class D are really poor condition, really poor area, very old. And most people would never admit that they actually own a Class D. Everyone would say that they own a Class C, but there are Class D properties out there, just no one will admit that theirs is a Class D. We usually play in this area, Class Cs, because these have well, let's look at the cap rate first. So cap rates for Class A's, it depends on the area. They're very small. It can be even lower than 5%. But let's say 5 to 6%, Class B would be 6 to 8%, Class C would be 8 to 10%. So if you go back to the prior slide, the higher cap rate means that someone wants to get paid more income to own the property. These properties are very nice. Everyone would like to own a property in Uptown that has Class A tenants and professional working class neighborhood, very safe area, so they're going to pay more for it, which means their expectation on profit per what they pay is lower. Does that make sense?
It's basically inversely related to the risk associated with the asset.
Right. Risk, trouble, some people that we know that own Class C and Class D properties carry a gun with them because it's a dangerous place. So some people don't want to deal with that. They want to have nice, clean area, and they'll pay a premium for that, and therefore they'll get less income for that price.
And another issue is that Class A and Class B properties are usually bought with institutional money. So it's big REITs, it's companies that own 20,000 units, it's development companies. It's not people like us that are independent owners or independent syndicators that are putting partnerships together. So the competition to actually purchase an A or B class is extremely, extremely competitive.
Yeah, there are a lot of people, take life insurance companies, for example. Their expectation on return is not very high. They would be very happy with a 5% return or lower. For example, we're targeting much higher returns. But those big players, they have a lot of money to spend and they need to put it somewhere that they can rely on getting the money out. Class A is pretty low risk, so they'll put money into Class A property. that's not usually the type of returns that we're going after.
But normally Class C will not degrade itself over time to become a high maintenance Class C, and
It will if you don't take care of the property. It will start to degrade over time, and it will move down to a Class D. Absolutely.
yeah. So
Yeah.
I'm sure you today will discuss only the positive and the nice stories. Why properties that you bought?
No, we'll
Can you
talk.
explain why they will.
Yes, I've got a slide for that.
Businesses that you had to step in.
Yeah, let's hold that question. I'll talk about that in the next 2 or 3 slides.
Do you have any statistical information about the risk for each class? For the
Statistical info. I don't have any statistics in terms of how often do they go,
Default?
how often they default.
when you decided in the class A, B, C, because you said the return is the reversal of the risk, inverse of risk. So do you have a certain data that's what people expect them?
I don't have any published data that says like, this % of properties go into default per class, but I don't know. But I can tell you anecdotally, we know several partnerships. In fact, I'm in a troubled partnership, and I can tell you about what went wrong in that partnership. There are a lot of things that you can do wrong to invest in Class C and in multifamily in general. You can pay too much for the property. The other partnership I'm in, well, actually they didn't pay too much. They bought it at a good price. You can spend too much money fixing it up. They did that, and you can have a poor company operating it, which is a kiss of death. And they had that problem. So we're actually turning that partnership around. I came in last March with another asset manager, and we brought in a new management company, and that property didn't distribute any distributions for 2.5 years, and now we're distributing it around a 10% cash-on-cash rate. But we did that primarily by replacing the management company. So there are a lot of things that you can do wrong, and that's why we're incredibly focused on not overpaying, on not over-fixing up the property, and by operating it well. It sounds simple. Just buy it right, put the right level of into it, and operate it correctly. It sounds easy, but it's not easy to do.
Well, there's a lot of things that go into the due diligence aspect. Before we decide to purchase a property, we're doing market surveys. We're walking every single unit. We're comparing sales comps. There's a lot of information that we gather and collect when we're doing our due diligence before we actually decide to purchase a property. We know that we can go in and make a difference in that property before we'll make an offer on it.
Right.
And then you used to have a chart with cap rate by time.
I have some charts that show cap rates changing. Cap rates change over time as well. That's right.
It's always between 8 and 10 in Dallas.
No, these are just roughly where it is right now in Dallas. Actually, Class C is even lower. There's lower than 8% in Dallas. But your point, cap rates do change over time, and right now cap rates are low.
Investors look at when they buy a home, right? They look at the cap rate, and then you look at the financials of the property, NOI, and then you divide that by the.
Well, every property we buy, we do a financial analysis. Just because cap rates are low right now doesn't mean that we stop buying, but we have to factor that in to our analysis. So right now, cap rates are at historic low rates, which means that people are paying a lot for properties right now. And that's why we actually like to look for properties that have something wrong with them, where we're not paying the market rate on cap rate, but we're buying at a lower price point. But I think my personal opinion right now is that people that are buying at stabilized values and at these very low cap rates, that it can be risky, because as soon as the cap rates start to go up in a year or two, or 3 or 4, or whatever the time frame is, and as soon as interest rates start to go up again, that they could see the price of their property go down.
And
so
there's a few things that influence cap rates are inventory levels, the availability of financing,
interest rates.
There's all kinds of factors that play into what the market assesses for cap rates. There is no cut and dry cap rate by class. It is somewhat emotionally based, I think.
It is. There's a strong dependence on interest rate, though. If you look at the 10-year Treasury mapped against cap rates, they track each other pretty well until like 2008, or when the market, then they both moved down together, they collapsed a bit. I don't have the chart in this deck, but there are Actually, if you guys, has anyone been to our website yet, NSpire Assets? If you look through the blog, one of the blogs talks about cap rates versus interest rates, and you can see over time how they've tracked each other.
One example of how we're considering utilizing the compressed cap rate that's occurring right now in the market to our advantage is by potentially looking at a supplemental loan for Villa Gardens, because the cap rate is for a stabilized asset. In the DFW, they're using a 7.5 cap. Our property value increased tremendously. So the bank is willing to look at that current value and determine whether we can get an additional supplemental loan that runs continuously with our existing loan based on that, that new value that we've created in that current cap rate. So it's not always bad when cap rates compress, because you can do some other things with your existing.
It's good if you want to sell, or
Yeah.
it's good if you want to
Sell
refinance.
is great. So although we like to buy properties, we try to use whatever market we're in to our advantage.
But I would say we have to be super careful right now about not overpaying, because prices are high and cap rates are low. Okay, so you asked what can go wrong. My graphic didn't come out very well here, but I tried to do a downward spiral in the back. We see these kinds of issues over and over again when we look at properties, especially the properties that we like to look at, which are distressed properties. So oftentimes there's a maintenance problem. So the owner, maybe they're running low on cash, maybe they don't want to hire an extra maintenance guy, but they start neglecting the residents, and maintenance calls go unanswered. And this property that we're going to talk about later, when we were walking the property, looking at the units, the residents were asking us to fix things in the units because the property, and we did actually. Yeah, there was one toilet we fixed, and one apartment had, I will never forget this. The guy had built a screen door to his kitchen with plastic wrap. He actually framed it and put plastic wrap in the door. And we asked him, why are you doing this? And he did it to keep the roaches in the kitchen, so they wouldn't come out into the rest of his house. This is an example of a tenant who's been neglected, and the management did not fix the problem. So obviously people won't stay. It develops a poor reputation, which so as your reputation goes down, you can't get as much rent anymore. And as your turnover increases, you're of course paying more. It's expensive to turn over the units. When the property gets troubled, owners will do anything to keep them full, because if you don't have someone in it, you're not collecting rent. So they'll start to take tenants who aren't qualified. Maybe they don't have a job. Maybe they've got a criminal background, but maybe they've got rent debt. Of course, that doesn't really help you, because if they've not been paying their rent before, they may not pay now. They may attract crime to the property. As the quality of the property goes down, you have to lower the rent more. So the spiral is starting to go down. Well, now I have lower rent. I don't have money to pay for my maintenance guy. Now that I have less money coming in, I don't have money to fix the property up. So the property starts to deteriorate. So many of the properties that we're looking at, they have major physical problems with them. They've got rent that's significantly lower than the rest of the market. And that's why the property is underperforming. They may not do anything to take care of their residents, so they may not do any events. The property that we bought last spring, we did an event this fall, and I think Nicole asked the lady, it was a barbecue, and you'd asked the one resident who'd been there like 15 years if they'd ever had any kind of event like that before, and the lady said no. They never did any events for their residents. And one of the things that I think Nicole does different than most of the other management companies that I'm at least familiar with, she'll do bingo nights, she'll set up soccer teams, she'll do barbecues, Thanksgiving dinners.
Event at one of the properties where there was some in-brought TV, big screen outdoors for the resident. They could like 100 hamburgers and hot dogs, things like that.
And when you do this, your residents, they want to stay, and then they want to tell their friends, and
Give away TVs.
It didn't hurt that Rent-A-Center probably abandoned that partner with one of their best customers too.
where was this at Travis?
Yeah.
The other things, there's missed opportunities. They may not be doing laundry, or they may have neglected their laundry room. They may not be doing vending. They may not be doing Wi-Fi. There's other opportunities to make money on the property that the owner may be missing. And finally, they may lose control of their expenses. So some of the easy things that we do are water conservation, where you go in and install low flow devices on the shower heads, for example. You fix leaks on the property. You put lower water consumption toilets in to cut back on your water expenses. Even negotiating lower electric bills, which sounds like a no-brainer. Some people just don't take the time to do it. Or negotiating the best insurance rates. All of these things can drive up expenses, making it expensive.
Straight transfer to the tenant?
Well, there's two cases. One is even if the tenants are paying their own utilities, the property has utility expenses. And usually water, for example, is not, there's no individual meter on each person's unit that tracks the water. It's allocated to the property. So that's one case. But most of our properties are all bills paid properties, which means that we're paying for the gas and the water and the electricity, and then we include it in the rent to the resident, which works really well for some of the lower income tenants who can't maybe get credit to qualify for some of the the electric contract, for example, or some of the tenants like the predictability of all bills paid, so they know what their rent is every month. And and also finally, some of the properties just don't have the ability to track on an individual basis. So electricity, for example, older properties, there's just one grid that goes throughout the whole property. There's no meter on each unit on some of the older ones. Newer properties often do have that capability, but even some of those properties will run them as all bills paid because we can be more profitable.
This whole list that Doug just presented is a perfect opportunity for us. If you look at it on a piece of paper, you're like, why do I want to buy a property that has high turnover, high expenses, crime, it's a poorly run business. Oh, who wants to deal with those issues? That is just the perfect scenario for us. And that's where we get our returns, because we take an asset that's falling apart, neglected, and you bring new life back into it. And that's where you get your return on your investment.
So also, maybe it's a stupid question, but when we are looking for housing, we always look at the school district, how cool is the area, and you're actually focusing on the areas where, quote unquote, nobody wants to come and live in.
Not really, no.
How do you drive that
Not necessarily. You're assuming that the entire submarket is like this, like the entire neighborhood is like this, and that's generally not the case. A lot of times, these are the problem properties in a submarket where the neighbors would like to use somebody to come and please buy this thing and make it nice, because we don't like having them as neighbors. One of the things I like to look at when I'm buying a property is that it's set by itself, it's off by itself, it's not, next door to a bunch of other properties, maybe one or two, close to a residential neighborhood. We look at what the property Travis Gardens, for example, is located right outside of Ryan Place and Fairmount Historic District, and right off of Magnolia in Fort Worth, where there's been a major transition of that neighborhood. So in most circumstances, these are in decent markets, decent submarkets. The property's just been neglected. So the property is the problem, not the submarket.
Well, imagine on the single-family side, if you have a nice house surrounded by dumpy houses, you'll never get a return from it. You'll never be able to sell it. And it's the same for us. First, we'll have a problem operating it well if it's surrounded by crappy properties. But second, even if we by a miracle we're able to perform it well, who's going to want to buy a property that's surrounded by other bad properties? So we've turned down quite a few properties over the last 6 months that were, if you looked at the numbers, it looked like it was promising, but you looked at the neighbors, and they were just surrounded by lots of bad properties.
One of my rules of thumb is that you cannot change the submarket. You can change the property, but you can't change the submarket. So if it's in a submarket that is not a good neighborhood, that is a bad submarket, I mean, even if it is a C-class asset that has opportunity for improvement, I will buy there. And there's several markets I want to buy in the Dallas-Fort Worth area.
Okay, Oop. So here's an example. Actually the numbers are pretty close match to the case study we're going to show you at the end. But here, let's assume we buy a 100-unit complex. It's got 75% economic occupancy. That means when I factored in the vacancy in the property and the people who aren't paying and the concessions that I gave on the rent special and all those things are added together, it's getting 75% of the total rent that it could achieve. And let's assume the expenses are $5K a door, so this is probably an all bills paid property. And let's assume that this results in an NOI of 180K. Further, let's assume that I bought it at around a 10% cap rate, which is on the high end of the cap rate side, which means the property was in poor condition. So because I'm generating 180K in NOI and the cap rate's 10%, what did I pay for the property? 1.8 million. So you can see the math. 1.8 times 10% is 180K. Now let's say I spent 500K on it. I'm able to improve, either I'm able to increase the rents or I'm able to get more people to pay at the current rent level. So my economic occupancy increases to 85%. Some of our properties are higher than 85%. Some are 90 and above, but this is a pretty conservative target. Let's assume that I'm able to decrease the expenses a bit. Maybe I've renegotiated electric. Maybe I've implemented water conservation. Maybe I've renegotiated my insurance. Maybe I've fixed some problems that were occurring on the property that required constant maintenance. That's not a dramatic decrease. So now my NOI, from these changes, my NOI went from 180K to 285K. Furthermore, let's assume that when I did the 500K, I fixed a lot of problems with the property. So maybe the leaks were roofs were leaking. Maybe the exterior was in poor condition. So I've gone in and fixed some of the deferred maintenance on the property. So now the owner is actually willing to pay a little bit better cap rate for it. Maybe it's 9%, which is closer to where it should have been if it weren't distressed. Well, now if I look at the value as a function of the NOI and cap rate, it would go from 1.8 up to 3.2. So basically, 285 divided by 9%, which would be 3.2. So in this case, I was able to increase the value from 1.8 to 3.2. Now I put 500K into it and I paid 1.8, so I'm all in for 2.3 million. And then my 2.3 to 3.2 means I made 900K of profit, roughly. Basic example. Does that make sense? This is what we're trying to achieve when we do a value add. This is normally the term we use, but forced appreciation. Okay. My last slide on this, and then we'll jump into a property. So this is just to help you visualize all the stuff we've talked about so far. So I first buy the property here at time 0, and I start to improve it. So now part of the value goes up because my income's going up, and the property is valued based on income and cap rate. So I've started increasing the value, but I'm not getting that out yet because I haven't sold the property. But I've started paying down the principal on the loan, and some of the money will go out as cash flow from operations. So let's say this is year 1. I'll pay out a small piece in cash flow. Some of it will be principal pay down. Some of its value increase from the improvements, but I've not realized that yet. Year 2 comes. Well, now hopefully the NOI has gone up a little bit more because either rents have increased or hopefully rents have increased a little bit. I've paid a little bit more down on my loan, and I have a little bit more cash flow. And it repeats. Finally, we hit a point where we sell. At that point, we take whatever cash flow from operations we had that year. We take all of the principal that we've paid down on the loan back, and we sell for the increased value. Plus, we get our base investment back. So this is if we refinance, it's a little bit trickier because we'll have money coming out in the middle. But this is basically what the life cycle would look like for an investment. Does that make sense? Yes?
So you have multiple people invest in certain property. Some people have different objectives.
Yes.
Some people want to cash out, whatever expense, whatever cash out you want to use it.
Yes.
Some people, because you worry about tax, maybe they want to keep as much as money and make some capital.
Yeah, different people have different objectives. So when we buy a property, we usually go in with the exit strategy in mind for that very reason. Are we going to, yeah. So if you look at our properties, let's go back let's look at these briefly. So Travis Gardens, I think the original intent was to sell it pretty quickly, to fix it up and sell it, right? If I'm not mistaken. It was a short hold.
We knew we were going to put permanent financing on it, but we didn't know how long we were going to hold it.
Okay.
So it was to hold it for at least 3 to 5 years.
Okay.
And
So-
then at the end of that first loan, we were in the property for 2.5 years, and it was a recourse note. So we didn't have a non-recourse note. And the partners decided whether we were looking at the option to sell it or to refinance it, and the partners voted on a refi. So we did that in August of last year, after owning the property for almost 4 years. And so now we're in a non-recourse Fannie Mae note, which is a long-term note, but it has a good interest rate. We can sell that property to someone, and they can assume the debt.
So this is an example of one where they went in with a 3 to 5 year hold, but they ultimately decided to change and do something a little bit longer.
So my point is that when you buy property,
yes.
you agree with certain strategy.
Yes, and then
Otherwise, we have different opinions.
exactly, but it can change as well. So if
Yeah.
the partners can vote to change, if the market conditions change or whatever, you know, if something should change. So Woods of Haltom is another example. We went in with 3-year hold projection. Well, now we were actually considering selling it just after 1 year of ownership because the market's hot and we think we can sell it and make a good profit and then use it and go invest in something else. Villa Gardens was purchased as a 10-year hold. So they went in, everyone went in with the expectation we're going to hold this property for a long time. So we usually go in with the end in mind so that everyone is on the same page, but the partners can vote ultimately to change that direction if they choose to.
When you say the holding 5-year, 10-year, what the difference? Meaning is holding means you're not paying out at all in 5 years?
Oh, the length of ownership of the property. No, we pay cash flow every year, and we pay cash flow if you refinance. But the by hold period, I mean when we're going to sell the property and exit the partnership.
There's a term called a value play and a yield play. And a lot of the properties, if it's a value play, that means that you're going in there and buying a distressed asset. To increase the value. A yield play, you might buy an asset that's a little bit more stabilized. And going back to that risk and reward scenario, that one may be for the guy that says, I want to hold a piece of property for 10 years and I want to have that steady cash flow. The value play may be for the more aggressive investor that says, you know what, I want to hit a home run in 3 years and I'm willing to take a little bit more of a calculated risk.
So if you visualize it from here, a value play has the green section. I've increased the value.
I understand that. I'm not saying you agree with the beginning or not. That's my question.
Yeah, no, but I think to just make sure Ron's point it's clear to everyone. If I'm trying to make money from the green part here, I actually want to sell it fairly quickly because I want to capture that value and move on to something else. But if the green section is gone, if I'm only making money from the cash flow, there's no reason to sell quickly because I just want to make money each year off of that.
It has to do with the structure of the loan that you.
The financing matters as well. Right.
Fannie Mae non-recourse note is really only available for stabilized assets that are yield play. So when you go into that type of loan, it's a long-term loan. The structure of that debt is usually 7 to 10 years, depending on whether you want to pay a little bit of a premium for the interest rate or a shorter hold. So with the yield type deal where it's a stabilized asset, the price of the property is going to be a little bit more. You're going to get permanent Fannie Mae non-recourse debt on the property. You're going to hold it for longer. The other types of properties that we're talking about that are properties that we're trying to increase the value on, there is no non-recourse debt available for those properties. So we're going in with sometimes 12-month interest with it'll roll into a fixed rate after the first 12 months. It's usually recourse. We want to get out of that recourse debt as fast as we can. And the fastest way out of the debt is either sell it or refinance it into a more attractive Fannie Mae non-recourse note. Because most of the time it's the sponsors are the ones that are carrying the responsibility for the recourse.
But Fannie Mae deduct the securities. Where are the securities? Just from the cash flow, the net cash flow? How do you do? So it's an LLC, correct?
It's secured by the asset.
Well, it depends on the type of
The
loan.
asset is the security. So
Yeah.
if something were to go wrong at the property, then they would take over the property. And
But-
the people that own the property are not personally responsible for the debt unless they've done something that's fraudulent.
Well, and it depends on the type of the loan. So there are recourse and non-recourse loans. If it's a recourse loan, that means that there are people signing up. There are guarantors who are signing up to be responsible for that property. If the property goes under, they're personally liable, whoever the guarantors are. With all of our investments, the guarantors are specific individuals and not the overall partnership. So most partners are not liable even for recourse unless they choose to be. For non-recourse notes, which are stabilized properties, the properties that are in better condition are lower risk. The bank views them as low risk. You can get a non-recourse loan, which means that if things go bad, the bank just takes the property back and you're not responsible.
The green part is capped, correct? You cannot increase forever the value of your...
It will go up as long as the NOI is going up. NOI should go up technically because with inflation you should be able to increase your rents every year. Now your expenses also increase, but hopefully you're able to increase your rents at least at the level of inflation, at least at in pace with your expenses. So your NOI should be able to go up a little bit more each year.
There's a point where you're not going to take an old property, run it so well, and all of a sudden it's going to be worth, from 18 a door to 50 or 75 a door. It's a classic. But there are limitations. Like Doug said, as long as you're operating property and NOI is going up, the cap rate stays the same.
Yeah, but the market
Or gets
increase the cap rate because of inflation.
Cap rates go up and down. I wish I had the chart that showed them over time, but they happen to be very low right now.
I think when Nicole started this, we were using round numbers, 10 cap rates.
10 cap?
And then
Yeah.
they tanked it.
Stabilized cap rate in 2007 and 2008 was like 9 because there was no money being lent. And now that things have gotten better and there's conduits back in the market, CMBS is lending, life companies are out there, conventional banks have money. It's really helped to improve cap rates and
Interest rates are at all-time lows.
when everything kind of fell apart in 2007 and there were a lot of foreclosures, Fannie did something else. They made a rule that no out-of-state buyers, you couldn't buy property with Fannie Mae debt unless you lived in the state where you purchased it. So one of the reasons why property values had increased so much and caused that bubble was because there was a lot of people from California here in the Dallas-Fort Worth market purchasing properties. Well, they went away, and now they're back. And so that's one of the reasons why we've seen such a compression in the cap rates. We've seen such competitive, fierce competitiveness in the market for properties. So some things are good, some things are not so good.
Are we in a bubble again? Can we use
It's funny. It's like I just don't understand why people can't learn from the mistakes, and they just seem to repeat over and over.
This is the quickest recovery, I think, in the real estate market, right, in the last 4 decades.
There's a couple things driving it in the Dallas-Fort Worth area that don't make me feel so uncomfortable. Number one, we have so many people moving to Dallas-Fort Worth, and that's going to continue. Our economy here is so strong. The second thing is they're not building new properties at the rate of the new people that are moving here. So, it's all kind of dependent on those occupancy rates and what's going on in your market. And those are things they're not going to change because it takes a long time for them to get a plan approved, to get to construction. We don't have a ton of building even scheduled still. So I'm not worried about that, about the California buyers, really pumping the market up here, because we didn't really even see that dramatic of a decrease in prices here. Even in the worst of times, cap rates were around 8.
Compared to
10.
Florida or
Yes.
Nevada or Arizona.
Yeah. So we don't have that type of bubble here, and we won't because we're strong. It's a strong market. which makes it competitive because people want to buy here. I mean,
But it's also it's an overall. I mean, will all properties be? Will the bubble impact all properties? No, but I'm sure there were properties back in 2008. I'm sure people overpaid, and just like I'm sure there are people overpaying for properties now.
You seem to having a much harder time now finding good value as compared to.
Well, the properties that we're looking at, there's not a lot of competition, right? No one wants to go out and buy a property that has a lot of problems, and not no one, but fewer people want to go out and buy a property that has a lot of problems with it. People want to go buy beautiful properties, you know. And
the other thing that we've kind of done, not on purpose, but everybody wants a property that's 200 units and more. 200 plus, that's a sweet spot because they can have the economies of scale with the operations. We haven't bought 200 units and more. We just found this little niche of 77 units, 88 units, 112 units, 142. And there's not as much competition there. We can close the properties, and now we have such a good reputation of being able to close what we actually make an offer on, that we get a lot more opportunities brought to us. So when you're first starting out, you're trying to purchase properties and nobody knows who you are, nobody wants to talk to you. So those off-market deals land in your lap when you get those relationships with the brokers, and they trust that you can, if they bring you a deal and you make an offer, that you're going to get it to the closing table. So I would like to purchase 200 plus units if the right deal comes along. I never really set out to buy this 88 unit property, but you'll see it's been a great deal for us. So we just try to keep an open mind and see, you know, what opportunities are out there. We're going to go tour 105 units tomorrow. So
You're managing all your properties? You're
yes.
managing all your properties?
Yes. Yeah, we own the management company, NSpire Management, as well as we own NSpire Assets. So I think that's part of the reason why we've been so successful, because I do play a very active role in management day to day on my properties.
How do you guys estimate the improvement costs? And that's a big risk factor, obviously, when you're buying a property. If we go back one slide, for example, I mean, to me,
what was the question? I'm sorry?
How do you estimate the improvement costs? I mean, a lot of your economics are based on, okay, how much money am I going to spend to increase the value of this property, increase the rent, occupancy, etc.
Yeah.
How the heck do you estimate that? I mean, you guys are going in and looking at this property. You take a bunch of
Do you wanna-
contractors with you.
Well, that's
Yes.
part of it.
Yes.
But,
Yes.
you know, I
Or
want to
what do
sing
you
some
do?
praises for Doug and Ron, because, you know, for the longest time, it was just me. I was the one-man show, or one-woman show, however you want to say it. And that is very challenging. And so when they came aboard, I said, this is what I need. I want you guys to create, you know, something on the iPad that when we walk into a unit, we can just check boxes on what needs to be replaced. So we were checking off boxes for appliances or whatever it is, and after you've done a rehab or two, you know how much things cost.
When she has a crew as well, which is,
Huh?
you have a crew as well
Yes,
that she
I
uses at every
I
property.
have my own crew that does all of the rehab from the exterior to the interior.
Before you buy it, right, you estimate X. What's been the worst surprise factor in the 4 properties you bought so far? You estimated X and it came in at what, X plus 20%?
Travis Gardens, we didn't have $80,000 in the budget for a chiller that we needed to replace, because when we went to inspect the property, it was December and the chiller wasn't running. All you can do is look at the outside of it. You can't test it, because if you know anything about chiller systems, they're either on heat or they're on air. And you cannot switch them back and forth, which is one of the challenges of owning that type of property, because, you know, we live in Texas. Like, we turn that chiller off in October. This year's been a struggle because it's been hot and cold, hot and cold. So we didn't have that in the budget, but the property was performing so well, and I'm very conservative when it comes to money, as far as making sure that we capitalize enough up front to cover any, you know, surprises.
No additional capital calls?
No.
Oh, no.
Never
Or
had.
No.
before?
Never.
Yep.
Larry's a partner in Villa Gardens. Yeah, we've never had to have one. And the other thing is, a lot of, what we do at the beginning is we're going to set our capital expense budget for what we're planning on doing for the repairs. But then the bank, especially if it's vanity debt, they'll make us put that $300 per unit per year. They take that every month in reserves and put that aside. So you have that as well.
We've even started holding even additional CapEx of woods. We even held 6 months more just to be super conservative.
But that affects your distribution to your partners.
It does.
If you hold it
That's right.
So much.
That's right. That's right.
So what's the interplay there? What's the dynamic on the last 4 properties? I mean,
so there's an equation that we have for each one. We usually do a month of, when we do distributions, there's usually a month of expenses, a month of loan servicing. There's, we take basically our current our working, what's the, thank you, not working capital, current assets. Oh, my mind's going blank. So we take our current assets minus our current liabilities. We see what we have available to us, and then we take out of that loan payments, debt service, and CapEx reserves. So it's a formula.
Yeah. I mean, there's history in Dallas with people using that as an excuse and not distributing to partners, saying, "Look, I need 10 months of expenses because that's what I'm foreseeing right now."
Well, so the second piece, let me just finish. The second piece is that we look at that up front when we're setting our working capital when we capitalize the deal. So if we capitalize the deal properly, we've got our reserves up front, so we're then distributing our cash flow. So Remy, we were just looking at this for Woods of Haltom. One of the partners was asking why. In this case, I don't know what you consider, how big of a delta you would consider to be, sandbagging, but we had distributed probably 97% of the cash flow, and the partner was like, "Why didn't you distribute the last 3%?" And that's pretty close. And we went through all the analysis, and we were holding back just a little bit more, but it was almost all of the cash flow. But I've been in other partnerships, and I'm in a few other properties where they've held on for 6 months, and you're like, "Hey guys, come on. You've got like $400,000 in reserves. Let's get them out." But Nicole, we don't on our properties.
The other thing is, we get paid. Our Class B shares get distributed when we distribute Class A shares. So I mean, I want to get my money.
No, let me ask the question a different way. I mean, how much discretion do you guys have in terms of what you can hold on to for future contingencies and how much you want to distribute? Is it sort of I've seen it done both ways in Dallas, where it's kind of absolute, that the guy can sit, have the money there for 6 months, and there's not a damn thing you can do about it. And others where it's built into the agreement that there's a formula you're supposed to follow, and you distribute as per that formula. And what do you guys do?
We have not written a concrete formula into our agreement. We haven't.
So
but we do follow a formula.
It's really our trust. I mean, not to denigrate it, I'm just saying, but it's the way your business model is. The investors have to trust that you will do this reasonably and you will distribute as cash flow permits.
That's right. But our history, our track record shows it, and you can talk to. But primarily that is to protect the partnership as well, right? Because if something's coming up, we want to save, we want to save money for that.
Any business has to keep. It's a question of degree. We all.
Yeah, exactly.
Any business has to keep money on hand to take care of contingencies, but one can use that excuse to go out 2 years, or they can use it to go out 2 months, depending on who the person is.
I would add maybe one other thing to Nicole's point, which is we're also compensated when we distribute and only when we distribute. But furthermore, we're also putting in our own cash into the deals, a substantial amount of cash. So I think in Townhouse we're 20% roughly. I think we put about 20%. In Woods we put about 20%. So we're putting a lot of we're a substantial contributor of capital to the deal. So we also I want to get my money out. Nicole, the last few distributions I've gotten from her have been within the first 2 weeks of the month. We do distributions on a quarterly basis, and Larry, you can comment. We get them. I'm in 9 partnerships now. I get her distributions sooner than anyone else's. Usually it's 2 months.
Distributions out before I got the partnership reports out.
I got a check in the mail.
Yeah, and that's because Nicole's getting compensated when that happens, and we're also want our money out. And it just shocks me that some investors. Well, some of the people that sponsor deals don't have their own money in, and their compensation isn't tied to when the distributions go out, so they're not as motivated.
There's another part of it, and that is happy investors want to invest.
That's true.
So we're very motivated to deliver on what we expect. You guys, hey, I've given you my money. Where's my money? So if we deliver on those expectations, and that makes it that much more likely that you may tell someone, hey, these guys are legitimate, or hey, you know what, I'm gonna go ahead and invest with you again because I've come to rely on you. One of the other things is it's not just the money, but we're very transparent. we're big into reporting, we're big into sharing the information. You're not just an investor that's like a mushroom where, okay, I've given you money and you just get a check and go away. So we back up with what we say, we're going to time and there's an incentive for us to be giving you money.
How many times do you do crisis in your business?
Oh, like every day.
Small crisis. The crisis you have to come to the investor and tell them, oh shit, I missed the people.
If you want to use an illustration, like Nicole brought up about the chiller. A chiller.
Another one. Give us another one.
Have I had to tell you anything at Bella?
Roof, something on the roofs,
The
maybe?
reason why I'm asking
The only other, I guess the only major thing is that we're in litigation on roof claims on 2 properties. But that's because we can't repair the roofs to code with what the
Insurance company is going to pay.
the insurance company has offered as a settlement, so we're in litigation. Most of the time it's good stuff, like we just reduced our tax basis, property tax basis from 4.6 million to 3.2. So.
I would say that's one of the other things. I mean, you know, from running a business, I mean, it's always better if you set your expectations low and exceed them, right? So we try to be conservative when we put our, you know, our pro forma out and our projections out, which is some other investors are much more aggressive and they're always apologizing. We're usually on the other way. We're usually more conservative and we're always coming in ahead of our projections. Not always, but generally speaking, we try to be conservative. I'm sorry?
Yeah. So let's say you have a distribution of preferred of 10%.
Yes.
Can you make distribution of 5 and then you defer the...
Yes. Yeah. We will distribute the cash. We have a formula we put out, when we make a distribution, we put out the spreadsheet that says, here's the formula, here's how we calculated it, here's what we're distributing.
Are there any incentives for people not to distribute? He was concerned. I was wondering, are there any reasons why they want to keep money in the bank?
Yeah, maybe. Yeah, they just want to play it safe. You know, they want to have a lot of extra cash just in case something goes wrong.
Well, so you have
No, whether you distribute or not doesn't impact the taxes because these are pass-through entities. So whether you, no, your tax either. If we hold all the money, and if we don't distribute anything to you, you will still pay the same taxes than if we distribute everything to you.
LLC?
Yeah, it's a pass-through entity. Yeah.
You don't get the cash, but you pay the tax.
Yeah, which is pretty painful if you don't distribute. Yeah. It could happen.
So the reason I mentioned it before, you know, it's like in every business you have to measure about how do you deal with the downturn or the crisis of the business, not that everything is going and the market is good. And this is why it's interesting to see how you dealt with conflict with your partners. You didn't have it.
She's just got the best partners.
The challenge I've had at any of these given properties this year is I've had a little bit of a challenge with occupancy going up and down in one property. But, you know, you go back and you readdress, are we doing the right screening? Are we getting the right tenants? And try to fix those problems and close the back doors. So.
But nothing catastrophic.
I mean, it went from like 90 to 95. That was the range of occupancy that went like that. So
We tried to do all of our homework up front and minimize those things.
Well, I think there are 2 things. One, you talk about management side, but you talk about if you have a different expectation from your investor. And then
well, when we and that's why, you know, when we do a deal, we have a private placement memorandum, which is like a 100-page document that tells everything we plan to do with the property, everything that could and will go wrong, and you know, it's a very heavy document, and the whole purpose of that is to put everything on the table. It's full disclosure.
How many, people investing for each property?
It depends on the size of the.
17 and another 8 in Woods.
Probably, yeah, 10 maybe, or it depends on how much capital you raise, because investors typically put in. So investors are usually putting in 100K, 50K, it depends. And if we're raising $1 million, then that would mean, you know, on average 10 to 15. If we're raising $2 million, 20 to 30.
Hey Doug, do we have to be out here at 8? It's 5 till.
No, we've got it until 8:30. Okay. I'm sure everyone wants to see the real example, so we'll get there in a second. Almost there. So Nicole already hit on some of this, why we like, my battery's dying, why we like Dallas, but it's growing. It's one of the few places in the country that is growing, which is always good because demand will increase. It's also landlord friendly. So in Dallas, if your resident's not paying their rent or they have another lease violation, it's very easy to remove them versus some other states where it's not so easy.
NAA is considering adopting the TAA lease
Oh, really?
nationally because it is so landlord friendly.
There's no rent control here. It's just a landlord-friendly state. And then I just mentioned here, capital is getting to be much easier to come by from the banking perspective. So my biggest fear is one that you mentioned earlier, that people will start overpaying even for the distressed properties. That's kind of my big fear. As long as we can still buy distressed properties at a good price, then I'm okay. But if people start paying a lot for those properties, then I'm going to start getting worried.
Hedge funds buying in Florida using the exact same strategy that you guys are using. I mean, I don't know if they made it to Texas yet, but I know they're in Florida.
Oh, and once people come in and there's a lot of buyers for those properties and they start to go up in price, well, then we'll look for something else because.
The main difference is the tie, running the management, the day by day. Hedge fund is giving to someone, and then over a few months,
That's true.
become a stress.
That's true.
Well, they're doing the value play as much as anything else. They come in and they want to flip it in a year.
Exactly.
But I think Ari has a good point. I mean, it's not, you can run these properties and get 80% economic occupancy fairly easily. I've seen that with several third-party management companies in properties that I'm in. But to get 85, 90% economic occupancy is not easy. And in those properties, I don't see many people doing it. Honestly, I just don't see many people doing it. You have to be really focused and have, in our case, it's an owner-operator. The same person who owns it is the person who's operating it. Usually achieves that level.